Assalamualaikum warahmatullahi wabarakatuh. Before that, let me introduce myself. My name is Arya Pamungkas Alam, and today I will explain about the question regarding revenue recognition, list accounting, and then patient accounting. And this video is made to accomplish or to finish the task given due to the midterms exam for Intermediate Accounting 2 course. And here is the first question regarding revenue recognitions, specifically talking about sales with allowance. And the question is on October 2, 2020, La Plante Company sold $6,000 of its elite camping gear with a cost $3,600 to Lynch Outfitters as part of the sales agreement. La Planta includes a provision that if Lynch is dissatisfied with the product, La Planta will grant an allowance on the sales price or agree to take the product back. Lynch expects the total amount allowance to Lynch to be $800 on October 16th, and on October 16, 2020, La Planta grants an allowance of $400 to Lynch because the colors for some of the items delivered was a bit different than what appeared in the catalog. And here we can get the key points of this question is that first, Elite Camping Gear sold for $6,000 and it has a cost for $3,600. And there's an allowance of $400 because of the colors issues. And the instruction first is asking about journal entries to record sale on October 2020, granting of the allowance on October 16, 2020, and any adjusting required on October 31st, 2020. When LaPlante prefers financial statements, LaPlante now estimates additional allowance of 250 will be granted to Lynch in the future. So first we are going to do the entries for the sales on October 2nd, 2020, which it is going to be accounts receivable on sales revenue both for $6,000 and cost of goods sold on inventory and both for $3,600. And then granting of allowance on October 16, 2020, it's going to be sales returns and allowance on accounts receivable both for $400. And then the last entries that we should make is that estimates additional allowance, or it's just going to be the adjusting entries, which it's going to the account going to be sales return and allowance on allowance for sales returns and allowance, both for $250. And the income statements for and then the next instruction is the instruction B, which is indicate the income statement and balance sheet reporting by LaPlante at October 31st, 2020 of the information related to the Lynch transaction. So this income statement and balance sheet are going to be involving the information that already stated above. So it won't be a complete income statement and balance sheet. So the income statement itself would be sales revenue for $6,000 and then less with sales returns and allowance. We got this from the October 16 transaction and then October 31st transaction. It's going to be $650 and then we will got the net sales for $5,350 and we will minus it with the cost of goods sold like already mentioned before on the sales on October 2nd, 2020. It's going to be $3,600 and the gross profit itself would be $1,750. That's it for the income statement. So the company got the profit for $1,750. And as for the balance sheet, the first one that we are going to input is going to be accounts receivable for $5,600. And then we are going to minus it with allowance for sales and returns and also allowance, which is cost $250. And from where is this accounts receivable accounts is we can take it from the accounts receivable on the sale and then minusing on the sales returns and allowance. There's a accounts receivable for 400 on the credit, so the accounts receivable on the debit would be $5.6 thousand, and that results that accounts receivable net would be 5,350. That's it about how can I solve uh, the 18.80. Okay, after that, we're going to move to E21.4, which this is talking about lease accounting, but specifically talking about lessee entries, finance lease, and unguaranteed residual value. So, from this question, we can take that first lease terms is 10 years, asset life is 12 years, fair value of building is going to be 525,000 and $176, and then annual lease payment is going to be 71,830, and then incremental borrowing rate would be 8%. And then lease is non-renewable and the assets reverts to the lessor. And the last key points that we can take from the question is that the lease is going to be paid in the beginning of the period. So the present value would be using the annuity date. So the first one is we are going to do the first instruction, which we are going to prepare all of the journal entries for the first year, second year, and the third years. And as for the first years, we have to first count the present value so that we can get the right use of the assets itself. So the present values, like I said before, we are going to use the annuity due, which this present value would use the 10 years and 8% of rate. And the present value itself is going to be 7.2468 and 9. And then we multiply it with the um, annual lease payment, which is 71,830, and we will get the annual lease present value itself would be 520,544.1087. And here is the journal entries. The account would be a right use of assets on lease liability, both for 544.1087. And here is the journal entry for the first lease payment. Like stated before, the payment would be 71,830. The account is going to be a lease liability on cash. So the lease left to be paid is going to be here. And then the second lease payment, which is going to happen in 2020, first we have to count the interest expense itself, where we are going to multiply 8% with the lease left to be paid here. And then we will get the result as like this. And then after that, we are going to count the lease liability paid, which we are going to minus the annual lease payment with the interest expense itself. So the result would be like this. And then the depreciation, since the right of use of this lease or this building is 10 years, so we are going to um, divide the right of use with 10 years, and here's the result that we will get, and here is the journal entry of the second payment or the payment on 2020. So there would be interest expense for this amount, and lease liability for this amount both on the debit and on the credit would be cash for this amount. And after that, we are also going to journal for the building depreciation expense for this amount. And then the contract account or like the credit account for this is going to be accumulated depreciation buildings for these amounts. And lease left to be paid is that minusing the last year's lease left to be paid with this year's lease liability that already been paid, and we will get this result for the answer. And then the last one is the third lease payment, which is going to be occurred on the 2021, which the first one is we are going to count the interest expense. Same like before, we are going to multiply 8% with the lease left to be paid. And here is the result that we got. And then there is the lease liability paid. We are going to minus the annual lease to be paid with the interest expense. And here's what we got. And then here is the journal entry. So it would be interest expense for this amount on the debit, and then lease liability for this amount on the credit. And last is cash on the credit for this amount. And don't forget to always put the building depreciation expense and for an accumulated depreciation buildings on the debit and credit for this amount, since it's going to be also counted every year. And after we are finishing the first instruction, we are going to move to the second instructions, which is talking about suppose the same facts as above, expect that Kimberly Clark incurred legal fees resulting from the execution of the lease of $5,000 and received a lease incentive from Sheffield to enter the lease of $1,000. How would the initial measurement of the lease liability and right of use asset be affected under these situations? So here is how can we solve it. The initial right of use or ROU should be adjusted due to the legal fees first, and then we are going to count the new initial ROU, which we are going to add the PV with the legal fees, and then we minus it with the incentives, and we're just going to move every information that we are already count from the instruction A, and then adding with the legal fees, which is going to be $5,000, and minus it with incentives, which is going to be $1,000. And here is the result that we get for the new initial ROU. So the conclusion is when Kimberly Clark incurs $5,000 in legal fees and receive $1,000 lease incentives, the ROU assets increase by $4,000, while the lease liability remains unchanged at this amount, and the legal fees are capitalized as part of the ROU asset, whereas the lease incentive reduces it. These adjustments ensures the financial statements accurately reflect the lease true costs and also benefits. And after we finish the instruction B, we are going to move to the instruction C, which is talking about additional insurance costs. So this additional insurance costs would affect the total that Leslie should pay annually by $5,000, which there's going to be an additional account on the journal entry that those account would be insurance expense on the debit and then cash on the credit, and both are going to be cost for $5,000. And then the last instruction of this question is going to be fair value journal entry, which is going to be on the debit lease liability for $10,000 and right of use assets for $10,000. Lease liability on the credit and right of use assets on the lease liability on the debit, right of use assets on the credit. And after we finish this E21.4, we are going to move to E20.10, which is going to talk about pension. Specifically talking about pension workshop. So, WebCorp sponsored a defined benefit pension plan for its employees on January 1st, 2020. The following balance related to this plan is here, and we are going to move it to the pension worksheet itself for the instruction A. So everything on here like plan assets, we're going to move on the memo record, and then projected benefits obligation, we're going to move it on the memo record too, and then projected benefits obligation, pension assets or liability, we're going to move it on the general journal entries. And also the last one is going to be accumulated other comprehensive income prior service costs would be inputted on the general journal entry. So the first one is we are going to create the worksheet first with this format. Then we are moving the account into the worksheet like this. And then the rest we are just going to move like the service cost for nine $90,000, which are going to add the PBO, and that interest cost for $54,000, which this is we get this from $600,000 and then multiply it with the rate itself, which is the rate is 9%. And here's what we got. The interest cost would be $54,000, and also these are going to add the PPO itself, and then actual returns on plan assets like stated here are going be the um to be the annual pension expenses, which is going to be the contra, or we are minusing it, and we adding it also into the plan assets, both for $55,000, and then adjustment with the expected return on plan assets. So the expected is 52, but the actual is 53. So we are just going to give a little adjustment, and it's going to be um $3,000 on annual pension expense and minus $3,000 on gain or loss. Why is it going to be minus? Since it's going to be loss. So yeah, it's going to be loss. And then PSG amortizations itself on the annual pension would be $9,000. Take it from the amortizations of prior service costs. And on the prior service cost, because it's amortizations, of course, it's going to be minusing the PSG itself. So it's going to be minus $19,000. And loss from change PBO, we got it from here. So we just have to add the gain or loss, which it's going to be a loss. So it would be not a minus. It's going to be $76,000, and the PBO itself are going to be minus for $76,000. And the contribution itself, we can also take it from there. It's going to be minusing the cash for $99,000 and adding the plan assets for $99,000. And the last is benefits paid by retirees. It's going to be on the projected benefits obligation or the PPO, it would be a minus for the PBO itself, which is going to be $85,000. And it's going to be also a minus for the plan assets, where it's going to be $85,000. And here is the balance at the end, or it's also going to be the journal entries. So the annual pension expense is going to be $111,000, and then cash would be minus $99,000, and prior service costs would be, wait, I think I messed this a bit. Um, Here would be like that, which is going to be $81,000. And then the gain or loss would be $73,000. And then pension assets or liability are going to be 120. And then PBO are going to be 735. $1,000, and then the last one is planned assets itself would be $549,000, and the journal entry would be like this. So there would be a pension expense, OCI loss, cash, pension assets or liability, and OCI prior service cost for this that that's it about my presentations, and I hope that this would help, and I hope that it would be useful for everyone who's watching this to help this to solve the problems regarding to these transactions. And that's all from me. Wassalamualaikum warahmatullahi wabarakatuh. Thank you so much, Miss.